Harry had $10,000 burning a hole in his pocket. He did something most investors would call crazy. He split it perfectly down the middle. $5,000 into growth ETFs. $5,000 into dividend ETFs. 1 year later, the results made him question everything about wealth-building strategies. Here's what nobody tells you about getting rich with ETFs. The growth side of his investment portfolio was up 17.6%. The dividend side, also up, but with monthly cash hitting his account. Which one actually made Harry richer? The answer changes depending on one factor that 90% of investors ignore completely. And today, I'm revealing exactly which ETFs the smart money is quietly accumulating for 2025. But first, let me show you why choosing wrong could cost you hundreds of thousands in retirement savings. Think about it this way. Growth ETFs are like planting seeds that turn into giant oak trees. You don't get fruit today, but in 20 years, you own the forest. Your compound interest does all the heavy lifting while you sleep. Dividend ETFs, they're your apple orchard. Quarterly harvests, immediate cash flow. Perfect for anyone who needs passive income streams now. The brutal truth is most people pick based on emotions, not math. And the math is about to shock you. See, when you're 25, every dollar has 40 years to compound, but when you're 55, that same dollar has maybe 10. This timing difference changes everything about your financial planning approach. Let's dive into the first growth monster that's been quietly crushing it. Schwab US Large Cap Growth ETF, ticker SCHG. Year-to-date return, 30.51%. Expense ratio, just 0.04%. But here's what made my jaw drop. This ETF holds the exact stocks. Institutional investors can't stop buying. We're talking Microsoft at 13.99% of the portfolio. Apple at 10.37%. Nvidia sitting pretty at 13.89%. SCHG doesn't pay you dividends to spend today. Instead, it reinvests everything for maximum wealth-building velocity. The 5-year annualized return? 21.73%. That means $10,000 invested 5 years ago is worth $26,300 today. Think about that. Your money more than doubled while you literally did nothing. No stock picking, no timing the market, just pure growth compounding. But here's the catch. You didn't receive a single penny in cash during those 5 years. Zero income. Everything stayed locked in the market, growing like a snowball rolling downhill. For young investors building their investment research foundation, this is exactly what you want. But what if you need income today? Enter Vanguard High Dividend Yield ETF, VYM. This isn't your grandfather's boring dividend fund. Year to date, up 18.61%. Current yield, 2.53%. But the real story? The 5-year return of 62.66%. VYM proves you can have your cake and eat it too. Growth, plus quarterly income hitting your account. With 453 holdings, you're basically buying a slice of corporate America's dividend growth champions. JP Morgan leads the pack at 4.19%. Broadcom at 4.13%. ExxonMobil at 2.44%. Every quarter, cash flows into your account for financial independence. But let me show you the real power here. That 2.53% yield means a $100,000 investment pays you $2,530 annually. That's $632.50 every quarter without selling a single share. Here's something wild. VYM has actually increased its dividend for 11 consecutive years. During the 2020 crash, while growth stocks plummeted 35%, VYM holders kept getting paid. That psychological comfort of receiving dividends during market chaos? Priceless for retirement planning. But VYM has serious competition. Enter Schwab US Dividend Equity, ETF-SCHD. This one's special. Year to date, 27.42%. Yield, 3.31%. SCHD uses a quality filter that most dividend ETFs ignore. It screens for companies with 10-plus years of paying dividends, strong fundamentals, and sustainable payout ratios. The result? You're not just chasing yield. You're buying dividend aristocrats positioned for long-term investment strategy success. Top holdings read like a financial advisor's dream. PepsiCo at 4.37%, Chevron at 4.36%, Coca-Cola at 4.23%. But here's what separates SCHD from every other dividend ETF. It's beaten the S&P 500 over certain periods while paying you to wait. The 5-year annualized return sits at 13.63%. Add that 3.31% yield, and you're looking at nearly 17% total annual returns. That's growth-like returns with dividend income. On $100,000, you're collecting $3,310 annually. That's $827.50 every quarter landing in your account. SCHD is where money management gets interesting. It's the hybrid that makes both growth and income investors happy. Now for the growth ETF that's been flying completely under the radar. Vanguard MegaCap Growth Index Fund -MGK. This fund doesn't mess around. Year to date, a stunning 38.64%. MGK focuses exclusively on the titans. The company's so big they basically can't fail. We're talking about businesses that define entire industries and shape global asset allocation strategies. The concentration here is deliberate. Top 10 holdings make up 61.86% of the fund. Microsoft at 12.89%. Apple at 15.67%. Nvidia at 14.43%. When these giants move, MGK amplifies their movement. 5-year annualized return, 21.13%. The volatility is real. During the 2022 tech crash, MGK dropped 31%. But for investors with a 10-plus year timeline, these dips become buying opportunities for compound growth. $10,000 in MGK 5 years ago, worth $25,900 today. No dividends, just pure, unadulterated growth. Now let's talk about the income investor's secret weapon most people have never heard of. iShares. Core High Dividend ETF, HDV, current yield, 3.37%. Year to date, 22.25%. HDV takes a completely different approach. It targets mature companies with fat dividends and defensive characteristics. Perfect for tax-advantaged accounts where you want stability with income. Energy dominates at 21.47% of the portfolio. Healthcare at 19.62%. Consumer defensive at 19.02%. This is your sleep well at night dividend option. Lower volatility, consistent payouts, and surprising growth when markets cooperate. The 5-year annualized return of 8.81% won't win any races, but combine that with a 3.37% yield, and you're looking at 12% plus total returns with way less stress. ExxonMobil at 8.40%, Johnson & Johnson at 5.78%, Chevron at 5.74%. These aren't exciting companies. They're boring cash machines that have paid dividends through world wars, recessions, and pandemics. For retirees or anyone within 10 years of retirement, HDV offers something growth ETFs can't: predictable income that keeps pace with inflation. So which strategy actually makes you rich faster? The data tells a fascinating story. If you're under 40, growth ETFs statistically destroyed dividend investing. That SCHG or MGK position could 5x over 20 years through relentless compounding. Time is your superpower. Let me show you the math that financial planning professionals use. $10,000 in SCHG compounding at 20% annually for 20 years, $383,000. $10,000 in SCHD, with dividends reinvested at 13% for 20 years, equals $115,000. That's a $268,000 difference. $250,000 from the same initial investment. But here's the plot twist. If you're 50 plus, those dividend payments become rocket fuel for financial goals. SCHD and VYM let you live off distributions without selling shares. That's true wealth. Income without depletion. A $1 million SCHD position generates $33,100 annually. That same million in SCHG generates nothing in cash. The Millionaire's Playbook? Start with growth, rotate to dividends as you age. Age 25 to 40, 80% growth, 20% dividends. Age 40 to 50, 60% growth, 40% dividends. Age 50 to 60, 40% growth, 60% dividends. Age 60 plus 20% growth, 80% dividends. This glide path strategy maximizes both wealth building and income generation across your lifetime. The tax truth nobody mentions could save you thousands. Qualified dividends get preferential treatment, typically 15% federal tax. But you pay taxes annually on every dividend payment. Growth ETFs defer taxes until you sell. That's decades of tax-free compounding. In taxable accounts, growth ETFs have a massive advantage through investment research optimization. $100,000 in SCHG growing at 20% for 10 years, then taxed at 15% equals $524,000 after tax. $100,000 in VYM, with dividends taxed annually, equals $410,000 after tax. That's a $114,000 difference just from tax efficiency. In retirement accounts, different story. Since you're not taxed on dividends in an IRA or 401k, dividend ETFs become way more attractive for retirement savings. Here's what smart money is doing right now based on institutional flows. They're buying both, but in separate accounts. Growth ETFs like SCHG and MGK in taxable brokerage accounts. Dividend ETFs like SCHD and HDV in tax-advantaged retirement accounts. This location optimization alone could add 20% to your lifetime returns. The worst mistake? Analysis paralysis. Every month you wait costs you. A 30-year-old waiting until 35 to start investing loses $500,000 in retirement wealth. That 5-year delay is catastrophic for compound interest accumulation. My controversial take after analyzing thousands of portfolios: the best investors don't choose. They strategically combine. Young Aggressive Portfolio, 40% SCHG, Pure Growth, 30% MGK, Mega Cap Growth, 20% SCHD, Quality Dividends, 10% HDV, Defensive Income. Balanced Portfolio approaching retirement, 20% SCHG, Growth Exposure, 20% MGK, Large Cap Stability, 35% SCHD, Quality Yield, 25% VYM, Broad Dividend Exposure. Conservative Retirement Portfolio, 10% SCHG, Inflation Protection, 30% SCHD, Quality Income, 30% VYM, Diversified Yield, 30% HDV, Defensive Dividends. Remember Harry's experiment? His growth ETFs outperformed by raw percentage, but his dividend ETFs provided $250 in cash he used to buy more shares. After reinvesting dividends, the total return gap narrowed to just 3%. The lesson? Both strategies work. The key is matching your strategy to your timeline and financial independence goals. If you need wealth in 20 years, growth wins. If you need income tomorrow, dividends win. If you're smart, you'll use both. Your move: growth or dividends, or the powerful combination. Execute relentlessly, because compound interest doesn't wait. And in 5 years, you'll either thank yourself or wish you'd started today.